Good morning, everybody. My name is Stephen Millard. I'm the Deputy Director for Macroeconomic Modelling and Forecasting here at NISA, and it's my great pleasure to welcome you to our summer economic forum. And the idea here is that we're going to present UK and global economic outlooks over 3 presentations, tell you who's doing that in a minute, and then there'll be time for questions. If you have a question, if you think of a question as the presentation is going along, please put it into the Q&A, and I will endeavour to make sure it's asked for you. When we get to the Q&A session, if you have a question, you can raise your hand using the raise hand facility. There are going to be 3 presentations, each just a little bit shy of 10 minutes. We're going to start off with Barry Naisbitt, who's going to tell us about the global economic outlook. We're then going to move on to Kimar White, who's going to tell us about the aggregate picture for the UK. And we're going to close with Anna Bhattacharjee, who's going to tell us about the UK regional outlook. Now, of course, you'll have all seen the Bank of England's forecast, which came out yesterday, presented a pretty bleak picture of the economy, with inflation rising to 13.3% and a 5-quarter-long recession with a peak to trough fall in GDP of, depending on which Twitter expert you read, is anything between 2 and 5%. It's not a million miles adrift from our forecast, as you will see a little bit later, but we're not quite as gloomy. We have inflation going up to 12% at the peak, and we only have a 3-quarter recession with a 1% peak to trough fall in GDP. So, but even though we're more optimistic than the bank, the overall picture, as I say, is pretty gloomy. But I'm going to allow my colleagues to enlarge upon that, and I'm first going to hand over to Barry Naisbitt, who's going to tell us about the global outlook.
Thank you very much, Stephen. I'm Barry Naisbitt. I'm Associate Research Director for Global Macroeconomics, and I'd like to rather briefly summarise the contents of our global economic outlook. Our global economic outlook is very much a team production, and the names of the contributors are on the slide here. Of course, any errors that I make today are purely mine. And to do our forecast, we used our global economic model NIGEM, with that, let's move to the next slide, please. And let's get into the detail of the forecast. I mean, I suppose our headline, which will, I guess, come probably not as a surprise to any of you, is that we've revised down our forecast for global GDP growth this year and next. And we've revised up our forecast for inflation. And on those 2 charts there, you can see the dotted lines of our previous forecast, our spring forecast, and the solid sort of burgundy line is our current summer forecast. We've revised down GDP growth globally in 2023 from 3.3% to 2.8%. And we don't see any acceleration in growth next year. So again, we have 2.8% for GDP growth next year. The revisions in terms of individual countries, we've marked down US growth in both years by around 1 percentage point, growth in the euro area by around 0.5 percentage point, and probably one of the big numbers is actually China, which we've revised GDP growth down this year by 1%, to give us growth this year of less than 4%. But we'd see growth picking up next year in China to 5%. I'll talk about some of those a little bit later. We've revised up this year global inflation to 9.6%, by about 1.5% both this year and next relative to our spring outlooks. The result of that is that a chart we initially started off a little while ago thinking about the scarring effect of the pandemic now has 2 scarring effects on it. The grey line on the chart there is our predicted level of global GDP that we made back before the pandemic hit, 2019 Q4. The first bit of the red line is our forecast, is what's actually happened now. And as you can see, global GDP is lower than we would have expected it to be. The black line continues that. That's from our spring forecast. And you can see that by the time we get to 2025, we were expecting GDP growth to be lower than we had done pre-pandemic. That's the scarring effect. Now, our current forecast, we've got a second sort of scarring effect due to the war, which is that second red line, which runs from start of 2022, effectively, onto the end of the forecast line. And by the end of the forecast, by 2025, global GDP is about just over 4% lower than it would have been had our forecast pre-pandemic turned out to be correct. So 4% lower than expected. I talked about some of the forecasts for individual countries. Perhaps two stand out here for me, at least. One is on the right-hand side, India, where you can see growth in India still expected to be very relatively strong, 7%, 6%. And also on the right-hand side, Russia, where we're expecting GDP to fall solidly this year by around 9% and around by 4% next year, as that economy gets hit by sanctions, but also by the effect of its war effort. The overall effect of those is that we see the global GDP growth, as I say, 2.8% both this year and next. In terms of things that have changed since our last forecast, in terms of some assumptions, there's two key parts. First, that commodity prices on the left-hand side here have risen more than we expected them to. Not just true for oil, which is the one that everyone mentions, and gas is the other one when we're talking about Europe, but also for wheat prices. And higher wheat prices are causing not just problems in terms of higher prices generally, but in terms of wheat supplies. So we've had some good news recently about the first ship being taken out of Ukraine ports with wheat in it, with grain in it, I should say, but there's still a long way to go there. The second one is we take market interest rates as our basic assumption. And you can see from the right-hand side chart that the expectation has been that policy rates will need to go higher than we would have thought back in the spring, or the markets thought in the spring. And on the US, that's pretty much consistent with the Fed's dot plot charts as well. Will inflation go up further? Well, for the OECD as a whole, we're expecting peak to be during this year. We probably think Q3, just over 10%, but then coming down. It comes down because our assumptions are around oil prices steadying, GDP growth slowing, and there isn't really in our forecast a further supply shock. But there might be, in which case one could see higher inflation. Also, for some economies within the OECD, is the question of tight labour markets and also inflation expectations, a feature that the Bank of England very much stressed yesterday in regard to the UK. There's risks to any forecast, and we talk a lot about those in the Global Outlook. We've got a piece in there by Crean Butler from Chatham House on the geopolitical consequences of Russia's invasion of Ukraine. And we also have a specific risk scenario that looks at the euro area, in particular, its exposure to gas and oil flows from Russia. And there's also a piece by my colleague Corrado Macchiarelli and two external colleagues on the euro area, and particularly monetary and fiscal policy interactions and the new transmission protection instrument, the TPI. But of course, the overall risks are somewhere around inflation sticking at higher levels. And so fighting inflation by central banks might come at risk of hurting growth. Emerging economies, which have largely seen their exchange rates depreciate and by and large see higher interest rates as a result of that, and also higher market interest rates from the US tightening, are now starting to face challenges. I probably don't need to say very much about government finances in the medium term as a result of tighter global conditions. And of course, there is the issue in some countries now where we've seen Sri Lanka, for example, with social unrest followed by both rising food and energy prices, changing climate conditions, but also this issue of food availability, food supply availability. Just finally, we have a piece each time looking at we call it a NIGEM topical feature, which uses our NIGEM model to examine an issue of current interest. This time we've looked at an oil price shock. We looked at an oil price shock of around an increase of around $60 a barrel, which is very similar to what we've seen over the last 6 to 9 months. The left-hand side shows the effect of that on GDP for major advanced economies, Japan, US, Eurozone, and the world as a whole. And as you'd expect, higher oil prices are negative for the world, both this year and next. And looking at the right-hand side, we do a sort of a range of emerging economies. Again, the similar pattern where the effect is stronger next year than this. And that's partly coming from, obviously, the monetary policy reaction to higher oil prices. But by and large, the effects are larger slightly larger, I think it's fair to say, in advanced economies than emerging economies on GDP growth. In terms of inflation, the effects, if we move to the next chart, please. In terms of inflation, the effects are slightly the other way around. The effects immediate, or this year, on inflation, the way the simulation works, but we assume the oil price effect is permanent, not a temporary effect. So the inflation effect also feeds through to next year, although it tends to diminish over time, whereas it gives a permanent loss to GDP. Let me just leave you with the final chart, which is a summary of our forecast. Just the top level highlights. And I'd just like to thank you for your attention and hand over to my colleague, Kamar White, who will go through our UK economic outlook.
Thank you, Barry. Morning, everyone, and thanks for joining us. As Barry mentioned, I'll be talking you through the outlook for the UK economy, and the work that I'll present here is, of course, again, joint effort with my colleagues, Stephen Millard, Rory McQueen, and Irvish Patel. So what I'll talk about in this presentation today, I'll speak on a bit on output, I'll speak on inflation and monetary policy, wages and real income, and then finally to say a few words on fiscal policy. So the main story, and of course you probably would have been following developments from the Bank of England yesterday, and the story is that there's a recession on its way. The bank has a recession forecasted in its recent publication of its monetary policy report. Similarly, in our outlook, we have a recession forecasted. In our forecast, we have the UK already been in a recession, but not one as deep and as long as the bank is forecasting. So we have forecast GDP to grow by 3.5% this year and by 0.5% next year. Now, as I mentioned, we are forecasting negative quarterly growth for 2022 Q3 through to 23 Q1. And of course, with the consecutive quarterly fall in output, this is of course what we constitute or what we call a technical recession. So in our forecast, we have a cumulative fall of around 1% in GDP. Now, in a box that we did in our previous outlook by Peter Dixon, we looked at what was the probability of a year-on-year fall in GDP. At the time, the probability attributed to that happening was 0. But now we think that there's a 50-50 chance of GDP in Q4 this year will be lower than GDP in 2021 Q4. At the same time, of course, inflation keeps rising. So what we have in our hands is a situation of stagflation. So we have our CPI forecast peaked to close to 11% in Q4 of this year, and around the same mark of Q1 next year. So this is, of course, much higher and more persistent than where we were, where we had it peaking in May, if you look at the blue line. So we have higher and more persistent inflation in our outlook now. So the MPC have actually acted, and of course, again, yesterday you'd have seen rate hike by the MPC. So they've started to tighten policy in an effort to bring inflation down. And we expect this to continue. So yesterday we saw, of course, a 50 basis points increase by the bank. So we expect interest rates to reach around 3% around Q1 or Q2 of next year, and we expect it to stay there. Again, the red line in the graph that you see on the right here is where we were in May. But with higher inflation, we expect more tightening to occur. But we think that together with the slowdown in energy price inflation and fall in demand, inflation will come down to about 3% by next year. But of course, this is still above the Bank of England's, excuse me, 2% target. The big question then is, did the MPC act too late? Should they have started to tighten policy, say maybe in the summer of 2021? Well, we have a box written in our, I think it's box B in our outlook, written by ex-MPC member Andrew Sentence, who certainly thinks the bank did act too slowly. So one can imagine that at the time the bank might have thought that inflation wasn't going to be persistent, but of course, with the benefit of hindsight, we can see that rates should have actually gone up. Now, a sign that maybe markets think that the MPC acted late is this chart that I have here on the right. So the red line shows the 5-year break-even inflation rate, which is a measure of the credibility of the MPC, and that rate has been rising consistently, as you can see, over 2021. Although it has dropped recently, as you can see, which may suggest that credibility is being restored. But MPC, of course, needs to keep raising rates to maintain that credibility. And what will be important, of course, will be the response of wages, which we'll look at on the next slide. So wage growth is currently 6.2%. Now, by recent standard, that is really high, but of course, it is still way below the rate of inflation. So in real terms, workers are taking a pay cut, a wage cut. So, and the other thing to note about this is, of course, the 6.2%, it's been very much driven by bonuses and wage drift as a result, because at regular pay growth, it's currently, I think, around just under 5%, 4.8% regular pay growth. So, and of course, looking at the chart here, we can see finance and business services sector, where bonuses are really strong, and this has been what's been underpinning this figure that we see for wage growth. Because if you compare, for example, the business and finance sector to, for example, the public sector or any other sectors you've seen here on the graph, you can see this performance is being largely driven by finance and business services, which have been doing particularly well. So another thing to look at is the pay settlements. Now, Of course, these will always be less than total pay growth because of the wage drift. So in the 3 months to June, they were at 4%. And on this graph here, you can see that expert HR and IDR had the same estimate. And given that, we forecast earnings to grow by 6% over the year as a whole. But we don't think that this will be enough to lead to a wage price spiral because the rate of the wage rate is much lower than the rate of inflation that we're seeing. And just to one thing before I go on, just to highlight that there's a box that I'd recommend you reading in our outlook. It's box A, written by Bill Wells, which looks at public employment service and its importance to a successful and inclusive labor market. So having said all that, the real income squeeze, of course, continues. Real regular pay fell by a record 2.8% in the 3 months to May, compared to 3 months to May in a year earlier. Real personal disposable income has been falling from 2021 Q2 and up until now, and this has largely been driven by higher taxes and inflation. So if you see the burgundy bar there, if you like, which is inflation, and then of course by higher taxes that we've experienced. So we think the fall in real income will continue, as we are forecasting a 2.5% fall over 2022. What is noticeable though is that we think the hit will be permanent. So looking at our forecast on this graph here, beyond 2026, it is going to be some 7% below its pre-COVID trend, which is the black line there, and even lower when we compare it to the pre-global financial crisis trend, which is our gray line. And we think that there are three sort of factors that have acted to cause this gap, and these are Brexit, which we estimate to account for about 3 to 5%, the energy price rises, which we think will contribute anywhere between 1 to 3%, and of course, discretionary fiscal tightening, which we attribute 1%. But we think the new chancellor can help because with budgets set in cash terms, debt and deficits will be lower as a percentage of GDP, because of course nominal GDP will expand by faster than we expected because of higher inflation. So and of course this is all based on published spending plans. So we're not making any assumptions. Here. So deficits will fall from around 5.1% of GDP in 22-23, roughly 1% of GDP in 23-24 in our forecast. So higher inflation has given the chancellor more fiscal space. The exact amount of fiscal space we're not sure, but that's arbitrary. But we know that given the higher inflation, we know that the chancellor has more fiscal space to help the most vulnerable households. So what are our recommendations as a result? So given the fiscal space, our recommendations are: one, redistribution, which I will leave my colleague Arnab, who will speak soon, will speak more on that. We are also recommending to maintain public services. So that is not letting spending on public services be cut in real terms. We are also recommending to maintain or to increase investment in public services. We also recommend that we do not use a public sector pay as a anti-inflation tool. Of course, we should look to reduce the trade barriers, and of course, do not risk a trade war over the Northern Ireland Protocol and risk this damaging the relationship with our largest trading partner, the EU, of course. In the long run, taxes need to reflect public preferences for services. So just in terms of, just to wrap up and to mention the risks, of course. So of course, with low growth, we're forecasting a recession, as is the bank. And of course, we have high inflation, so that screams a stagflation. So recession is on its way with with even higher inflation. Now, there are upside risks to GDP and inflation. The upside risks are stronger than expected wage growth that we're forecasting. Households reduce savings by more than forecast to smooth their consumption. On the downside to GDP, of course, even higher inflation leading to weaker demand, and of course, further disruption to trade, which we are hoping does not happen. And I will just leave you now with the forecast summary, and then I'll just hand over to my colleague Arnab, who will talk about regional outlook. Thank you.
Thank you, Kamar, and good morning, everyone, for joining us today. The once-in-a-generation cost of living crisis, as we face today, compounded by the continued war, political uncertainty, and policy paralysis, continue to ravage through British economy and society. Well, that's not much of a surprise. The impacts are pervasive, but particularly affecting households, communities, and regions already disadvantaged by decades of underinvestment and deprivation. So that is the central message that we bring to you today in collaborative work with several colleagues as part of our Summer 22 Outlook for UK households, the devolved regions, and the devolved nations and the English regions. Our central messages are 1.2 million households hardest hit will have food and energy bills exceeding their ability to pay through disposable income in the current financial year 2022-23. But further, as households dip into their savings to avoid the perverse choice between eating and heating, including their lockdown savings, if they exist, their accumulated financial resources plummet, leaving 5.3 million or 1 in 5 households without any savings by 2024. That's a twofold rise from April 22 levels, and about 7 million living paycheck to paycheck without enough savings to support 2 months of income. Regional, as evident, there is no quick respite. This is not going away in this short while. 7 million households, 1 in 4, with insufficient savings to cover 2 months of their income, as I said. Regional and income inequalities are up, but we think there is enough fiscal space. Kamar has just said the question of fiscal space is a bit arbitrary, but from whatever calculations we see, from the OBR and so on, we think there is enough fiscal space to support both struggling households in the short to medium run and level up lagging places and regions in the long run. The protocol helps, given the Brexit that we have had, particularly in Northern Ireland, which has a projected recovery slightly better than the UK as a whole, but it is still way behind London and these parts of the Southeast, and the Midlands in particular continue to struggle. The impact of really astronomical inflation, particularly in energy and food prices, is pervasive across the income distribution, as you can see from the chart here. This is for 2022-23. The dark maroon bars here show us the effect of inflation itself, and the other bars show us the effect of fiscal policy that to some extent can exacerbate it or mitigate against. And in particular, we find that the May emergency grants in shaded maroon at the top managed to cushion some of the adverse effects of rising food and energy prices. This was after we urged the government urgently in our previous outlook in May 2022 to bring about quick action to help struggling households. And we are happy that the then Chancellor brought in the May grants. But more is required now. The leadership contest in Westminster comes at the wrong time because it shuts down the fiscal space exactly at the time when it is most needed by struggling households. The stress on household finances are going to increase, particularly in 2023-24. And therefore, there is urgent action needed, particularly in the budget which is to come in the autumn. As it stands, 1.2 million households will be left with having to choose between eating and heating in 2022-23, and 1 in 5 will be left with no savings by 2024. The number of households with insufficient savings will almost double from 3.9 million to 6.8 million between April 2023 to April 2024. These are devastating numbers. In the chart here, please note the sharp rise between April 22 and April 24 here in the percentage of households with no savings. Unprecedented hardship is projected. While some of it is already being felt, no doubt by almost all households across the United Kingdom, much more is on the way. And unfortunately, that is the bleak projection that we bring to you today. These are the households with insufficient savings, or our projections of them. Now, there are two things to bear in mind here, or to observe here. First, going into the COVID crisis, low-income households had to draw down on their savings while high-income households accumulated lockdown savings. However, now with the cost of living crisis, higher income households are able to draw upon their lockdown savings and somehow survive, while low-income poor households have nowhere to escape. This is the basis for urging the government to bring about emergency fiscal support. As expected, the burden spreads unequally across space, regionally along the familiar north-south divide. In particular, households with colder homes in the north and the periphery bear the brunt of the energy bills crisis. Finally, as expected, economic performance diverges across the regions of England and the nations of the United Kingdom. In particular, Northern Ireland enjoys a little bit of the warm glow from the protocol, given the Brexit we have had. But this is still way behind London, which is growing 4 times faster on the right-hand scale. Please note that there is a difference in the scale. London is on the right-hand scale. Also, this short-term boost in Northern Ireland is not a manna from heaven, being largely an outcome of a boost to trading. But trading is low value-added activity, and persistent gains will only accrue if there are larger investments, including FDI, focused on good, green, and globally relevant activities. Then, in terms of policy options, we urge urgency both along the short-term and long-term horizons. We think there is sufficient fiscal space to do both, and we elaborate on this in the outlook itself, and to not do so would be suboptimal. In the short term, a progressive and robust budget later in the year must address rising poverty, through a combination of targeted welfare at the lower end, that is the universal credit uplift, and continued energy grants spread over a larger proportion of households, that is at the lower point there. Okay, so 400 to 600 pounds across 11 million households in the bottom part of the entire bottom half of the income distribution. In the long run, the focus must lie on addressing regional regeneration and flailing productivity. It is time for the government to show some real leveling up ambition. We leave you with what must be the lowlights: enormous financial hardship, pervasive and running into the medium run, potential ambition for regional regeneration, and the urgent need for robust fiscal policy. The fiscal space is available, but is there the will? Time will tell. Thank you very much. Over to Stephen.
Thank you very much, Arnab. Thank you, Barry, and thank you, Kimar, for your presentations. We're going to move on to a Q&A. If you have a question, you can either write it into the chat or you can raise your hand. We're going to try and enable people to ask their questions by unmuting them, so we'll see if this works. So we have a question from Guzal Abdishu Kurova. Sorry, I probably really badly pronounced your name, but Guzal, can you go ahead and ask your question? Or can someone unmute Guzal so he can ask his question? There you go. I think you're okay now. Guzal, are you there? Okay. Technology never seems to quite work. While we're waiting on Guzal, maybe we have a question from Peter Dixon, who has written a box for us in the past. So if we can unmute Peter, and then maybe Peter can ask his question.
Oh, hi there. Can you hear me?
We can, yes, thank you.
Marvelous. I just wanted to ask whether, first of all, you thought that much of the criticism aimed at the Bank of England, both in the press and by certain politicians, is somewhat unfair, given the exogenous nature of the shock to inflation. And secondly, whether you, or what is your view on this idea that the contraction of real incomes as a result of higher inflation will act as an automatic brake on activity in the UK, thereby eliminating or reducing the need for the Bank of England to act too sharply, which risks making the recession even worse than it already appears likely to be?
Good question. Kimar, do you want to have a crack at that one?
Yeah. Thanks for the question, Peter. Very interesting question. And I agree to a certain extent that some of the criticism is a bit unfair on the bank, but let me try to sort of qualify that statement. We benefit a lot, and a lot of commentators benefit a lot from hindsight, of course. The bank can do very little about the supply chain issues. As you mentioned, exogenous shock. They can do very little about what happened, or what's happening rather in Ukraine. But what the bank should have anticipated is, when we were exiting lockdown, right? The bank would have known, or should have anticipated, that there's a lot of pent-up demand because a lot of economies have been opening, certainly within Europe and here. So they should have anticipated that and should have acted then and started increasing rates. So that's at least my criticism of the bank, not sort of foreseeing that. But of course, there are elements that are out of their control. On the second part of your, and just to add to that as well, what people were looking for and continue to look for from the bank is communication. So how they communicate on their policy could have been much better, I think. In terms of the situation that they find themselves in now, and whether or not that the cut or squeeze on real income sort of limits the need to continue this rate hikes. I think it's a difficult one to say because again, because primarily the shock is coming from a supply side and not the demand side. So will the squeeze on real income be enough? Will that fall in demand be enough to bring inflation down? I have my doubts. So I think the bank has to be sort of aggressive in its approach to monetary policy to bring inflation back down to target.
Thank you.
Thank you, Kima. We have a question from Vangelis Marangudakis. I'm just murdering people's names, and I really apologize for that. But Vangelis, maybe we can unmute you, and you can go ahead and ask your question.
Hi, you did a very good job of pronouncing my name there, so well done. But my question is, how much of a balance is there between fiscal support for households and avoiding further increases to inflation? Because we've seen that debated in the Tory leadership contest at the minute. Okay,
well, we're very, very deliberately not going to comment on the Tory leadership contest. But Anna, perhaps you could give me your view, or you can give us all your view on the balance between providing support for households versus the effect on inflation.
Right. Thanks a lot, Vangelis. That's a short question which potentially requires a lot of thought and discussion. But just a couple of things to put in there. Okay, so the point is that the idea that we are putting forward there in some ways is whether fiscal policy, acting through fiscal policy and welfare might put further inflationary pressures. Under the current circumstances, we think not that much, because anyway, real wages are falling. So inflation is very high, real wages are falling, and so maybe not that much. The other point to make, of course, is that there is a connection between inflation itself potentially and inequality. And so this is something which is also a part of the debate. The second point here is that fiscal policy must, in some ways, coordinate with monetary policy. If monetary policy is, tightening, then fiscal policy must, in some ways, coordinate to try and provide some relief. And now we have seen that that has not happened in the past, and we have been critical of that in terms of our analysis of the Bank of England, for example, at the time of the COVID crisis. But once again, we potentially see the same thing happening. So in some ways, we think that the policy mix and the fiscal space which is available to the government could be used much better. The final point to make is that, of course, the then Chancellor, in the May grants and previously, has tried to use the fiscal policy to try and help the population. But we do not think the approach of fiscal policy has been sufficiently well targeted. It can be better targeted to bring about better outcomes in the medium to long run, in the short to medium run, right, without putting further fiscal pressures on the government itself. I think better targeting can help. Thank you.
Thanks very much, Arnab. There's another question here from an anonymous attendee. What is our view of the effect of tax cuts on inflation, growth, and incomes? I think that's a question that would take a very long answer. The shorter answer, though, is that what the fiscal authority needs to do, whoever they are, is they need to work out what is the target of fiscal policy? What am I trying to achieve via fiscal policy? And then they should set taxes in order to achieve those objectives. And the idea that fiscal authority should be ruled by any particular target for the debt or deficit seems just to be the wrong way of going about fiscal policy. And this is why in our recommendations that both Kima and Arnab went through, we're very much, the government should be using its ability to borrow in order to support those households through the crisis who really need it. Okay, Lucy Wood has a question. That's thankfully an easier name to pronounce. Lucy, can you go ahead and ask your question?
Hi, can you hear me?
We can, yes.
Hi, everyone. So my question is about the levelling up policy and how realistic do you think that is? I think Arnen sort of answered some of that question in the last thing he was talking about, but I just wondered how realistic you think that is, and do we need sort of much stronger policies to ensure that inequalities don't get even worse in this country?
Arnab.
Yes, thank you, Lucy. This is a sort of $1 million question in some ways, or £1 million question, really. I suppose the question is, given the enormous hardship that the population is going through and is likely to go through in the medium run, should there be, enough emphasis on leveling up, which is really long term? And we think yes, for several reasons. One is that there is a productivity challenge that we face across the country. There's a question of diverging regions, and these divergences are increasing. So the divergences that we see across the households falls unevenly across space, and that creates further issues. Now, the question is, how much of this or how much of that? And I think one way to go about that, we think the appropriate way to go about that would be a bit of both. Means the government, at the same time as they have the immediate problems of trying to address poverty in the short to medium run, must also have a view towards the far horizon to try and see how different places can be brought closer together. The leveling up white paper is a good start in that process. Now, that momentum must not be lost. So there needs to be larger emphasis on a combination of public and private investment, on training and jobs, catering to good, green, and globally relevant activities, and supporting trade and FDI. These must go hand in hand with short-term welfare policy. That's our view. Thank you.
Oh, thank you.
Thank you, Arnab. Now, I'm wondering if we can have another go at unmuting Guzal, because his question actually follows a little bit from something that Arnab just said. So Guzal, should we try again to see if we can unmute you and you can ask your question? Guzal? Any luck? No, these kind of technical glitches always happen. We'll keep going. Gary Dimsky. Let's see if we can unmute Gary so Gary can ask his question. Gary, are you there? Gary, any luck?
Yes, one more
Perfect,
time.
perfect.
Okay, sorry for that. Yes, technical. I guess we've implicitly had a partial answer to the question of tax cuts versus the fiscal authorities' focus on targeted relief for those who need it. I'm really, really pleased to see the direction of analysis here. And understanding that we don't want to comment directly on the Tory candidates' positions, but what I'm hearing is that the proposals that have been made about tax cuts of various kinds are perceived in the NISR analysis as not so important or definitive in terms of the broader trajectory of this period of recession and inflation. Would that be Would that be an accurate reading of what we've heard?
I'm not entirely sure we think that. When we do the forecast, we have to condition on what we already know. So announced spending plans, announced tax plans of the government. That's not necessarily our central case in terms of what we forecast might happen, particularly given that both the candidates for the Tory party leadership are advocating large tax cuts.
Yeah.
So in our analysis within the forecast, we haven't looked at tax cuts, and that's because just of that conditioning forecast assumption. But the thing I would say, and I'll allow either Arnab or Max or Kemar, whoever wants to come in on this, is that when we analyze what we think the government needs to do to deal with the crisis that we're facing at the minute, blanket tax cuts, particularly of income tax, we just don't think are the right answer. I don't know if Arnab or Max or Kemar, you want to add to that?
I'm happy to, just in the context of the analysis that we did into household savings being frankly decimated by high inflation and stagnating incomes. In terms of policy responses, and forgive me if I cross over with what Arnab has mentioned earlier, comparing with what these support measures in the latest rounds were, most of them were sort of one-off cash grants. So in our analysis, those one-off cash grants, even to these households who are experiencing the most hardship as a result of inflation, in terms of how it affects their savings, most of the time, as soon as that one-off cash grant goes into their bank account, it bleeds straight out again as a result of their very, very high expenditures. The analysis that we do into savings needs to sort of be seen in the context of very high expenditures, that finding that we mentioned at the start. So those households with those 1.2 million households who have food and energy bills greater than their income, those are just two of their essential expenditures. It's just two. So you can imagine how high their monthly expenditures are. So these one-off cash grants, therefore, just come straight out of their balances. So in that context, when we think about support measures going forward, these do need to be consistent, which is why we called for a £25 per week uplift for 6 months. That is going to be far more beneficial and quicker to implement as well. We have to bear in mind that a lot of these support measures have only been delivered recently because they get sort of the £650 grant to universal credit claimants is delivered through 2 installments, and the first one has only really just happened. The £400 to every household is delivered monthly between now and I believe it's March or May. So in terms of how it helps people is quite minimal. So that's why our recommended support measures are £25 per week uplift to keep that consistent and to address those balance sheets.
Can I come in briefly? So the question was about tax. So the question is whether we think that fiscal policy should be implemented and should be effective. If fiscal policy needs to be effective or have some bite, then the government must have the means to raise money from somewhere. Now, there's a question of whether how much of that should be taxes and how much of that should be, borrowings, and exactly how the mix of taxes across the whole income distribution between households and corporate sector needs to be. We do modeling of these things largely based on what the government plans, but the broader question is that we think that actually the government has a role to play here. Fiscal policy has a very important role to play here. So, kind of that is important for us. So a combination of both, through a combination of both taxes and borrowings. Thanks.
Thank you, Arnab. We have a few questions here in the Q&A from anonymous attendees. But before we do that, I've just had a message from Guzal. He's got poor quality internet, which is why he wrote his question. So I'm going to ask it on behalf of him. And the question, which I'm now failing to actually see in here, is whether we think that the impact of the move to net zero will help growth in the UK in the short run. And I wonder, Kimar, if you, oh no, I have the question. How do you think our transition to a green economy will affect economic growth in the short term? So I was wondering, Kimar, if you might want to have a go at that.
Stephen, I think Kimar has a bad internet as well.
Yes. Off you go, Kimar.
Hi, yes. So thanks for the question. Just a short response here. The transition to a green economy, of course, this will of course help a lot with the reduction in our energy bills. But of course, this will create also a sort of a new sector, if you like. So what we'll see happening there is the creation of employment, which will of course contribute quite a lot to growth, particularly in the short term. So it's a cut in our sort of energy and utility bills, and of course a contribution to employment.
Of course, the big question is how quickly that we'll be able to achieve this transition, and whether we will be able to do it in, you know, over the next 5, 10, 15, 20 years, and how quickly the effects will be felt. You know, maybe the recession could act as a spur, if you like, for us to start putting the investment in. And again, that's one of the reasons why in our recommendations for government policy, we strongly advising to actually take the opportunity to really up the level of public investment, and the transition to a green economy gives them a clear chance and opportunity to do that. We got time, I think, for one more question, so I'm going to go to one of the anonymous ones. No, or maybe not. No, I'll yeah, a good question here from Jeff Matsu. So Jeff, if we can find you and unmute you, you can go ahead and ask your question.
Hi, can you hear me?
We can.
Yeah, I was just asking in terms of quantitative tightening and whether or not you feel that the government, that the bank's current plans for the year ahead in terms of reducing the stock of its assets in quantitative, or reversing the quantitative easing it's had, is sufficient, and also just in terms of the sequencing in coordination with bank rate changes, whether you think that more can be done on the QT side first, and that it doesn't necessarily all have to come from bank rate. Just wondering what your views are. Thank you.
Kimar, do you want to have a crack at that one? Kimar, are you able to join us from your phone? Okay, well, I'll while we're waiting for Kimar, maybe I'll have a go at it. I mean, as the bank has really emphasized, the policy tool is the bank rate. The QT is really about just getting their balance sheet into a much more sort of normal, more manageable position, if you like. And to the extent that the flip side of the asset purchases are that the commercial banks are holding larger liquid deposits with the Bank of England than they would ideally want, then at least in the first stage of the QT, it's unlikely to have much effect on the real economy. It would just enable commercial banks and the Bank of England itself to readjust their balance sheets to a more sensible position. So is the QT plan sufficient? I think that's a very difficult question to answer, and we'll see over time. But in terms of how that's sequenced with changes to the bank rate, I think the key policy tool is the bank rate, and that's the one the MPC are going to concentrate on using. I hope that answers your question, Jeff. Okay, we have actually run out of time. It's gone 12. I'm sure everybody is looking forward to their lunch. Before we go, though, I'd just like to very much thank Kamar and Arnab and Barry for their presentations, for Max helping us out with the answers to questions, and most importantly of all, everybody in the audience for coming along virtually, giving us lots of hard and difficult questions to try and answer, and lots of issues to think about, more importantly, as we move forward and produce future economic outlooks. So thank you, everyone, and goodbye.
Thank you.